Brandon, just as a reminder, we do have mics in front of you guys. They are staggered because we don't have enough mics for all of us. But just so that you guys are aware, they're directional, so you can just move the mics around. They should be able to catch you. Green light means they're on. They can hear you. Otherwise, it doesn't get broadcasted. We cannot hear you guys. Nick Curry. Absolutely. Nick Curry.
Here.
Dan Jansen.
Here.
Christine Hoffman.
Here.
Brandon Maresma.
Here.
Jennifer Rutolo.
Here.
David Cohill.
Here.
John Patrich.
Here.
Matthew Grocki.
Here.
John Gostilla.
Here.
Jason Sharp.
Here.
George Candler.
Here.
Ed Dawson. John McDaniel.
Here.
Lance Hewish.
Here.
Debbie White.
Here.
Thank you.
Okay, let's do approval of minutes to start. We're going to do a voice vote by board. This is for the quarterly pension board meeting held February 25th, 2025. Why don't we start with the firefighters board? A motion and a second.
Motion to approve the minutes.
Second.
All in favor?
Aye.
Any opposed? Okay. The general board, motion and second, please.
Second.
All in favor?
Aye.
Any opposed? Okay. And then police board, motion second.
Motion.
Second. All in favor?
Aye.
Any opposed? Okay. Then we have, by the police officers board, we're going to approve the special pension board meeting held April 8th, 2025.
Motion.
Second. All in favor?
Aye.
Any opposed? All right, general board, special pension board meeting held May 7th, 2025.
Second.
All in favor?
Aye.
Any opposed? Okay. New business, we've got Purvis and Gray.
Dustin, are y'all ready for me?
We are ready for you.
All right, fantastic. Good afternoon, everyone. My name is Megan Camp. I am a director in the audit department of Purvis Gray & Company, and I'm here today to present the results of the fiscal year ended September 30th, 2024 audits of the pension plans for the general employees, the police officers, and the firefighters' pension funds. So all of you should have your bound copies of the financial statements. I will be referencing page numbers throughout this presentation, so please feel free to flip to the pages as I bring them up. So the big question on everyone's mind, we're pleased to report that for all plans, we were able to issue unmodified opinions on the financial statements. The opinions can be found at page 1 of the bound financial statements for each plan. Through page 3, you'll find the standard discussion of the nature of the audits and the respective responsibilities of us as auditors and management, and a discussion of the procedures performed over the required supplementary information as well. We're also required to issue a separate communication to members of governance, and that should be found in the separate insert stapled within your bound copies. There were no changes in accounting policies during the year under audit or in the disclosures. Significant estimates, including the fair value of investments and actuarial assumptions, remain unchanged. We're happy to say that there were no audit difficulties, no disagreements with management, or any corrected or uncorrected misstatements to report. And we thank management and the finance staff for their assistance in making this a smooth audit year, as always. The financial statements will include the auditor's report at pages 1 through 3, the MD&A at pages 4 through 10, basic financial statements at pages 11 and 12, notes to the financial statements following those basic financials, and the required supplementary information, and that's including the schedule of changes in net pension liability and the related ratios, the contributions and investment returns, and those will begin at page 22 for the general and police plans, and 23 for the firefighters plan. So the statement of fiduciary net position for each plan will be found on page 11 within each bound report. So all plans had fantastic year-over-year returns. You can see for the general plan, there is an increase in restricted net position available to pay benefits of 19.2%. That primarily came from an increase in the investments. For the police plan, the year-over-year increase was approximately 21%. And for the fire, there was a realized increase in fiduciary net position of 25.3%. And if anyone has any questions throughout this presentation, please feel free to just stop me. I can't see y'all and share my screen, so you'll have to just speak up, interrupt me, not a problem. So the statements of changes in fiduciary net position are going to show what inflows and outflows contributed to those changes in fiduciary net position that we just discussed. So as you can see, the investment income is the highest it has been in 5 years, and that does bear out across all plans. The general plan's contributions only show employee and employer, whereas the police and fire are going to show employee and an employer delineation. So there will be employer and the state of Florida for the police officers plan. And then for the firefighters, there will be employee, employer, and then the employer is broken out between the city of Jacksonville Beach and the city of Jacksonville. So across all plans for this fiscal year, the contributions, the benefits, the administrative expenses, and the refunds did remain relatively stable. Your main change is going to be coming from that significant increase in the investment return. So the required supplementary information begins at page 22 for the general and police and page 23 for the fire. For the general plan, the net pension liability, all input factor amounts remained relatively stable, with the exception of the difference between the expected and actual experience, which is an actuarial adjustment, and the plan net investment income. This led to a significant increase in the funded percent from 76.45 in the prior year to 85.28% in the current year. The net pension liability also decreased in terms of the percentage of covered payroll represented. That went from almost 106% last year to just over 65% this year. And each of the plans had a wonderful year this year. As you can see, the trend bears out across the police plan. This saw a jump from 87% to over 99% funded, and a decrease of the covered payroll percentage from over 70% to just over 3%. And the fire plan went from 73% funded to 92% funded, and 289% of covered payroll to 77%. All of this despite relatively stable contributions, benefit payments, and ancillary expenses across all plans. And this trend analysis, particularly over the last 5 years, is going to highlight the long-term focus of the pension plans and the relative unimportance of short-term market volatility. Along those lines, we also do present annually a disclosure showing the sensitivity of the net pension liability to different long-term return rates, noting that changes in these estimates will significantly impact the estimated net pension liability. So you see for the general plan, it's significantly higher with a 1% decrease and significantly lower with a 1% increase. Here you see that 1 point difference for the police plan would be the difference between a net pension asset or a significant decrease in the funded percent. And that trend repeats as well for the fire plan. This brings us to the ever crucial discussion of the importance of consistently meeting or exceeding those actuarially determined contributions each year, which, as you can see for the general and the police, which are consistently in a significant excess, and the fire, which bears out on a net basis, the city is consistently meeting these targets year over year. And as far as the results of the audit, that is all I really have. I'm happy to answer any questions anyone has.
I don't see any questions here, Megan.
Okay. All
Thank you.
right.
Thank you
Well,
so much for
do
your,
you need
presentation.
anything else from me?
Anyone?
Any discussion?
Thank you, Megan.
Thank you. And thank you again to the finance staff, Rosalind, Dustin, Eddie, everyone who helped us in getting all of the items that we needed together to complete this audit quickly and efficiently. It's always a pleasure working with all of you.
Motion to accept.
So we're gonna do a
Good.
roll call vote by board. So why don't we start with the firefighters board? We need a motion and a second to start.
Motion.
Second.
I apologize. What board was that?
Firefighters.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
Motion and second from general.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Marisma,
Yes.
Jennifer Rutello.
Yes.
Police board.
Motion. Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocky,
Yes.
John Godstilla,
Yes.
Jason Sharp.
Yes.
Perfect.
Okay. Thank you, Megan.
All right. Thank you very much. Y'all have a nice day.
Okay. All right. Brad's going to give us the actuarial reports.
Good afternoon, everyone. This is the first thing we're going to cover is the typical annual actuarial valuations that you see on a regular basis. These are based on the assumptions prior to the experience studies, which are the next item on your agenda. So bear in mind that these are using existing assumptions. The actuary cannot unilaterally change your assumptions. We can recommend you change those, but any assumption changes, regardless of the expertise or the opinion of the actuary, always must be adopted by the Board of Trustees before they are utilized. So these are board adopted assumptions. If we go to the purpose, determining the annual required contributions for the fiscal year beginning October 1st, 2025. So these have been involved in the budget process for the 25-26 fiscal year already. We look at the funded ratios of the systems as of October 1st, 2024, and I'll remind, excuse me, so I'll remind the boards that you saw some funded ratios in the audit report. Those are used for financial reporting under Government Accounting Standards Board Statements 67 and 68. You're required to use the market value of assets for the purpose of determining those funded ratios, and the retirement systems use a smooth value of assets. So we recognize gains and losses over a period of years. That's for the purposes of smoothing contribution rate volatility, to the employer, so that you don't have an investment gain and the employer's contributions go down dramatically, and then the following year, if you have an investment loss, they go up dramatically. It's very disruptive, particularly in a municipal budget that doesn't have a lot of elasticity. They tend to collapse in around things. So it's easy to go down, but it's not as easy to recover on coming back up. So if you see a funded ratio that's different than the audit report that was just presented, that's the reason why we're using a different value of assets that's smoothing the returns over the last 4 years. And finally, we're going to assess risks and trends, look at a short projection of results under the current board adopted assumptions. For anybody who hasn't been involved very much with the valuation process, you're accumulating assets so that on this chart the investment income can meet the cash flow needs. So you have 3 mature systems. If you were on a pay-as-you-go basis, if you didn't have any accumulated assets, then the city would be responsible for 100% of the benefit payments to the retirees and beneficiaries. So a portion comes from contributions from the employees and the employers, and the remainder comes from investment income on. So we very purposefully are pre-funding benefits throughout people's careers, so that there's no surprises, so to speak. When somebody retires, we don't suddenly have to adapt for the fact that our cash flows increase. We've been anticipating that since the day they were hired. This is going to be relevant. The second bullet on the bottom, this is a little different than prior years because of the experience study that we're going to talk about in the next agenda item. The present values are how we view each of the benefit payments. So individually, we look at the probability somebody's going to retire and they're going to live the next month and receive the next payment. If that payment were $1,000, but we don't owe it for 15 years, maybe the person is still in active status, or they could be retired, but there's a probability they'll be alive in 15 years, so we need to know how much do we need today to be equivalent to that amount. And these are called present values. So if you are we're presently assuming 7.5% interest, you actually, of that $1,000 that you're promising 15 years from today, you only need $338 today, so considerably less than $1,000, because you're going to remain invested. That $338 is going to be invested with ANCO, Mariner, sorry, and if we achieve the 7.5% assumption for the next 15 years, it'll grow such that you'll have sufficient funds to pay that $1,000. But I also wanted to look at what do we need if we assume 7.25, and that's relevant because of the experience study. We're recommending that you reduce the long-term assumed rate of return. So if you have a lower investment rate of return assumed, then less of your future benefit payments, and in this case the $1,000, are going to be paid through that investment income portion. You know, the upper half of the graph. That investment income portion is going to be a little bit smaller. We still owe $1,000. $1,000 hasn't changed. So instead of $338, we would need $350 today to equate to the present value. And if you look at 350 versus 338, that's a 3.5% increase. So it's certainly a material change. That particular assumption will increase your. I picked 15 years because it's roughly the average duration of your benefit payments, and so it will increase your liabilities by about 3.5%. Therefore, it will reduce the funded ratio and increase contribution requirements. But that's the remainder of this is still with the existing assumptions. This is more for a newer trustee. We have these present values, so we look at that $1,000 that we owe in 15 years. We look at the potential of the 15 years in 1 month from today, 15 years in 2 months, 15 years in 3 months, and so on until we reach what the actuaries call omega, the end of the mortality table. We're not assuming that we have any immortals or Highlanders that we have to fund for, so we stop doing our calculations. We add them all up, and that represents the liabilities of this entire disk that you see. We have assets accumulated to pay for a portion of that. We have an unfunded liability. We don't have to pay that off today. You don't owe monthly payments all at once. You owe them for actives. You don't owe them anything unless they terminate and request a refund until they become eligible for benefits and so on. So our cash flows are extended out over decades. So we don't have to pay the unfunded liability off rapidly. So boy, I don't know what to call I know for sure the smaller piece of the unfunded liability portion is purple. Something, we'll call it lavender. It's kind of a light lavender. Is the rest of the unfunded liability, and so the yearly amortization payment, and then we have the present value of future normal costs, which are represent the future careers, the future working careers of your active employees. So having sufficient assets to be 100% funded only means you have paid for everything that's accrued to date, but future salary increases, promotions, additional years of service they fall in the green areas. Olive and is the larger section there, and regular green is the portions. So we pay those. Those actually are represented by each additional year. If somebody works an additional year of active service, we pay the normal costs. So that by the time an individual is hired and retired, if we pay their normal costs throughout their career, we should have enough assets accumulated for their retirement. It's a brief summary of the members, the inactive members. We have 260 roughly retired members and 17 vested members, all of whom are relying on these boards to fulfill the fiduciary responsibilities and meet the benefit promises. Ultimately, that they become eligible for. In addition, we have 347 active members, additional households, and they probably have dependents. Your retirees may not have a lot of dependents anymore, but certainly your active members have dependents. So that's a part of the purpose here, to make sufficient contributions so that all of the benefits are paid on schedule. This we're going to skip for today in the interest of time. And this is that asset smoothing that I talked about, why the assets are different than straight market value of assets. I'll leave it to Brendan to get into greater depth if anybody has any questions, but it's not particularly relevant. So here we are today, we're making decisions on the last hour of the last trading day on September 30th. Is that really the best long-term representation of the value of the assets that we have? And so it's not just for budgeting purposes, but kind of we span most of a market cycle and look at the returns over that trailing period, and that's a little more representative of what we should expect with respect to the accumulation of assets, as opposed to looking at these momentary points in time that they might, on occasion, it was a few years ago, might have been 10 now, but so the last trading day in September was just a terrible day. So from open to close on that last trading day, you had like a 3% change in the market value of assets. So we're not interested in market timing. And then the contribution requirements. If you adopt these reports today, I guess the contribution requirements are shown here as a percent of pay. The only thing I wanted to point out is it's interesting. We've had does anybody remember was it 6.45% a long time ago? Member contribution rates, but 7.95 has been the member contribution rate. It's fixed. It's been that way for a long time. And yet, if you look at the third from the bottom row, the member portion, the general and the police are 7.95%, but the fire is 6.46%. And I'm fairly confident that Trustee McDaniel is having 7.95% withheld from his paycheck. So what's going on? And the reason is because it's a closed group, and we expect that it's 7.95% of the 24 payroll. You convert that to dollars, and then you say, well, how many people are still going to be left in fiscal 26? So effectively 2 years later. So 2 years later, it's a closed group. We expect some of those people are no longer going to be there. So their contributions in that future fiscal year are less because there's fewer. And if you divide it by the same payroll, you calculated it initially based on a larger payroll, and that's probably not a very accurate statement. So strike that as that could be a confusing reference. It's a smaller dollar amount divided by the same denominator because of a few years. Does everybody on the fire board understand? That's why it's represented here. When we go to do the dollar contributions, everything is accounted for. So the dollar contributions appear on this page. The city, for the general police and for their agreed their fixed payment to the firefighters retirement system, they're paid on a dollar basis, not on a percent of pay basis. So this is more important with respect to adopting the reports. Becomes an invoice to the city. It also becomes an invoice to the city of Jacksonville. The city of Jacksonville contributes to the firefighters pension fund in the first week of October. The interlocal agreement requires that. So they make their contribution on a dollar basis immediately. And the opportunity to make the payments in full for the general police and the remainder of the fire benefits is shown here. The difference between paying it throughout the year and paying it at the beginning of the year. Remember, we're assuming investment rate of return is 7.5%, or later this afternoon 7.25%. If you contribute something sooner and expose it to the investment market, then you need less. We saw that with the present value calculations. We didn't need $1,000 to be able to pay $1,000 in the future. So if you make quarterly payments, because they're not exposed, the first quarterly payments exposed to the market for the majority of the year, but the last quarterly payments only in the market for a few months. So if you make all of your payments at the beginning of the year, they can be a little bit less. And why would you do that? Well, it's not like the IRS. It's has to do with when your revenues become available. If you're parking money in general revenue and it's not earning any appreciable investment return, why not put it in the retirement system and give yourself the opportunity to invest in a diversified portfolio that's professionally managed? So let's see. So the projections aren't particularly valuable other than the direction of things, because the experience study is going to shift these somewhat. So again, in the interest of time, I'm going to move to the funded ratio. So here we go. These are different than the audit report. They're a little bit lower, which is code for things are going to get better, because we didn't. You had well over 20% return for the fiscal year ending September 30th, 2024. We didn't recognize all of that yet. Yeah, so you have an investment return that's waiting to be recognized. Next year is going to be a pause, because 3 years ago we had maybe 2 or 3 years ago we had some bad experience that we have to completely recognize. But the holdover of the good experience will help us the next few years. We also adopted, because it's a Florida statutory mandate, the Florida Retirement System mortality tables. They adopted new mortality tables for the Florida Retirement System. There's a general set of mortality tables for the general retirement system, and there's a safety set of mortality tables in the case of FRS, they're typically called special risk, and at least that's what I think. Are the police officers called special risk, or just the firefighters? Everybody's good. Okay.
Correctional officers.
What's that?
Correctional, under FRS, correctional officers.
Fantastic. Great. So I don't have to call all my friends and correct the bad information I might have given them. So we have, so there's safety tables to reflect shorter life expectancies. The police and firefighters have long held without much ability to substantiate their claims that they're likely to live shorter life expectancies than civilian employees or teachers, and that's been borne out the last few years. There's been a couple of mortality studies that were the first of their kind to accumulate sufficient public safety and public sector employee data, in order to produce the volume of data necessary to perform the study. So let's see. I think it's worth looking. Oh, it's worth looking. The trailing five general employees is 7.8, 8.1 for police officers, and 8.1. All of those. So the trailing 5-year average at present, all of those are greater than 7.5. So that'll be relevant in some ways when we talk about the experience study. But now with the attorney present, I believe it's appropriate. If there's no questions, I believe it's appropriate for each of the boards to adopt the valuations that were summarized in this presentation, and those will become an invoice to the respective employers for the purposes of contributions to be made for the fiscal year beginning October 1st, 2025, year ending September 30th, 2026.
Yeah, I had a question.
Sure.
For the police board, the Bay City contribution, it was the number appeared differently. I could be on the wrong page. Am I supposed to be looking at A3?
And well, I'm not sure what you're comparing, but on page 11, let's go back to that. On page 11, in the bold, 1,047,542 should match A3.
It does.
If
It's
you
just a
look at
little
the
blurry, and I was looking at the number below it.
the lower one,
Got it.
is that satisfactory? Any other questions?
I have a question about that, but I do have a comment. So what I hear you saying in your presentation is that the average employee working for the city of Jacksonville Beach lives about 15 years after retirement.
Well, the duration isn't. Well, let's. Which system do you want to pick? I'm gonna pick general because I was voted most optimistic of my high school class. So
No response is needed.
oh, okay, but well, but nonetheless, if you go to if you go to C as in Charles 6, right? Yeah. Does everybody know what moral hazard is? You don't want somebody to predict when you might stop breathing. So, especially if there's a financial advantage to that person. So, well, at age 60, I don't want to be strongly associated with doom every time I come here. And so, if you retire at age 60, you're expected to live on the order of, as a male age to age 85. You've already survived all of the risks to get to 60. So you may say, well, yeah, but I read all kinds of articles that suggest the average life expectancy is in the 70s, but that's from birth. And males in particular in their 20s, there's a lot of foolish choices. So if you made it to 60, you're likely to, so you may encounter some of those in your daily activities. But women, so women would be all the way to age 90, believe it or not. So,
Brad, do you want to mention maybe since we're talking about the mortality tables, are we going to have to change mortality tables next year?
no.
No.
They kind of early adopted it.
Oh, we did. Okay, good. Okay, perfect.
They're reflected
In this report.
in the results.
Excellent.
So, to be clear, when the boards make their individual motions, it would be for an assumed rate of 7.25?
No, that hasn't happened yet.
Okay, sorry.
So it's, well, the cat's out of the bag. But,
The first step would be to approve the valuation report.
right, that's,
And then we'll go
Yeah, I
to
think-
the second disclosure after that.
so,
I see.
so, and that way, this is me speaking very subjectively. It's not disruptive to the budgeting process. If you were to adopt a dramatic change in assumptions today, and impact, this report will impact the budget that starts this fall. So the next report will be adopting assumptions for the 25 valuation, which will first affect the 26-27 budget.
Okay.
That's,
I thought they would be approving for you to.
before I
Joke
leave,
that out for future
before I
years.
leave, I hope
I
I hope
see what you're saying.
that the boards give us clear direction. But this is the same as last year, as far as you'll be approving the valuation reports under the existing assumptions, the current assumptions. Okay.
Do you want to talk about well, let's vote on this one. We'll start with the police board. We need a motion, a second, and then can we stop? Any discussion? Any further discussion before we vote to approve? Okay. How about the police board? A motion, second, then voice vote.
You're looking at fire.
I'm looking at fire. I'm saying voice. All right.
Motion to approve.
I'm back.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
General board.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Rutello.
Yes.
Police board.
Motion.
Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocky,
Yes.
John Costilla,
Yes.
Jason Sharp.
Yes.
Okay, Brad, thank you. And now Pedro Herrera.
So, just before we jump off of that, there is a required disclosure imposed on us by the legislature a few years ago, where each board has to set. Oh,
Pedro, let me stop you for 1 second.
sure.
I guess we need to vote on the experience study results separately.
Well, I'm gonna speak to that
Should I do more about that? Okay, go ahead.
some.
Sorry.
That's okay.
But I like what Pedro's about to ask.
It's the first time I ever know. So, separate and apart from your valuation report, and separate and apart from your consulting, and separate and apart from what you're going to be discussing with your actuary in terms of your experience study, which is essentially the assumptions that are used as the foundation for your valuation report. There's an additional disclosure imposed on us by the legislature. You gotta love bureaucracy. So each board has to set a rate of return for this year, the next several years, and the long term thereafter. It has no bearing on your funding, which is what your valuation report is responsible for. It has really no bearing on your investments or your asset allocation. It's simply a piece of paper. It's simply a disclosure that we are required to make. Generally speaking, we'll make this disclosure. We'll have the boards make this disclosure in conjunction with the adoption of the valuation report, and really for practical reasons, your actuarial valuation report contains the investment return assumption, which in theory is what you believe the plan is going to earn for the next 30, 40, 50 years, whatever it may be, and that's why you're using it for funding purposes. So typically speaking, assuming your consultant and your actuary are comfortable with it, the boards would set the same rate of return despite the language in the disclosure. It's an annual exercise, so it's a little bit counterintuitive, but you'll use the same investment return assumption as your declaration of your return, your rate of return. It doesn't have to be the same. However, if it's not the same, the likelihood is in 2 or 3 years when the state gets to it, we'll get a letter back saying, well, why did you use X for funding purposes, but you believe you're going to return Y, right, as part of this disclosure. As long as we have a good reason, it's not an issue, but again, generally speaking, since we do this exercise annually, if you're going to change your investment return assumption for funding purposes, then it would stand to reason that you would similarly declare a different rate of return corresponding to that, right? So I believe here it's 7.25,
7.5.
7.5. So
Oh, that's right. Yeah, the fire board pursuant to their interlocal agreement is 6.5.
okay, so then I think we're going to need 3 motions anyway. But if assuming your consultant and your actuary are comfortable with it, I would look for a motion from each of the boards to declare or set the rate of return for this year, the next several years, and the long term thereafter at 7.5% for the general, 7.5% for the police, and then 6.5% for the fire.
Correct.
Is there a separate percentage for the, you said, immediate and then long term, or same
It's
percentage?
the same rate of return that you're declaring. Again, the language is a little bit misleading, I would say, but for this year, the next several years, and the long term thereafter. So that's the rate that we're.
But in no way does that obligate you in future years. So next year, when you get the valuation, whatever rate is in there, we're going to recommend under this same disclosure language that you use that rate, whether it's 7.5 or 7.25 or 2, whatever rate is in the val is the rate we're going to recommend for that, setting that expected rate, even though it says, again, next year, next several years, long term thereafter. This is just an additional requirement that, quite frankly, is just kind of a gotcha.
Like a placeholder?
Yeah.
Why is the firefighters low? Are they more
That was
pessimistic?
pursuant to the interlocal between the city of Jacksonville Beach and Jacksonville. That's they agreed that that's what the rate of return. That's what the assumption would be. The investment return assumption would be, and it's really just for funding purposes. I would imagine.
It's tied to the
How much contribution?
City of Jacksonville Police and Fire Pension Fund itself, their assumption. So if their assumption changed, the firefighters board assumption would change in lockstep with it.
Okay. Police board?
And that's a contractual obligation. They don't have much of a. The fire board doesn't have much of a choice.
Did it again.
You did.
Can we switch these two? Firefighters, can we have a motion and a second to adopt 6.5% for the
Rate of
expected
return.
rate of return?
Second.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
General board, 7.5%?
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Rotolo.
Yes.
Police board, 7.5%?
Motion. Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocky,
Yes.
John Godzilla,
Yes.
Jason Sharp.
Yes.
Pedro, I have a quick question. What do you think, Reader's Digest, what do you think was the reason behind the state passing this mandate to have to set it?
You know, I've when this was adopted, there was a big push by the state, by the Division of Retirement, where they were trying to have pension funds essentially lower their investment return assumption for valuation purposes. And so I don't. You guys were 7.5, so I'm assuming you guys would get the same letters. But they were. There was a time where after every annual report was submitted or filed around March or April, you would get a response letter from the state with any issues with the report, and there would always be this request. Demand is a strong word, but for the board to consider lowering their investment return assumption. And so I think this was an attempt to maybe, as you heard, got you right. So this was an attempt to have boards kind of revisit on a more frequent basis, not only for funding purposes as part of the evaluation, but explicitly talk about what the rate of return is and what they're expecting to return, so that if there was a difference, the state could come back and kind of have a basis to have a discussion with the board and maybe exert some influence. That's not a legal opinion. That's just my general thought. But frankly, I don't know. It's such a, I hate to say meaningless, but it doesn't impact really any of on a practical basis what the board does or the assets or what the plan sponsor contributes, right? So I really do think it's disclosure for disclosure's sake, and maybe blame it on the day job. There may have been some behind the scenes attempts to try and just isolate boards or have them maybe conflict with their own actions in the administration of the plan.
But thank you.
I was going to just add into that real quickly. Around that same time, there were some other additional requirements, like within the valuation or the audit, you had to show the liability if your assumed rate was dropped by either 1 or 2% from the actual, and you had to show what the liability would grow to. And then in addition to that, you also had to show like how long it would take the plan to run out of money if contributions ceased. It's like the plan sponsor is required to make contributions, so what's the point of going through that exercise? But there were all these things to kind of make the pension plans look a little bit more negative. So again, it was all around that same time that these things
You had to reflect. You had to reflect the past 5-year returns with what you expected. So again, it was and the conspiracy theorists, there was a push for many years kind of away from defined benefit plans and trying to push more towards defined contribution models. And so there was a lot of thought that maybe a lot of these disclosures were really meant to just try and make these DB plans look worse than they actually were. But again, that's just that's maybe my own personal bias.
Okay, Brad, back to you.
What's that?
We're going to do
The experience
take us to
study.
the exciting world of experience
did,
study
did they
results.
do the motions?
Yes.
Sorry about that. So I handed out. You're gonna have to pay close attention. They're stapled. They're not spiral bound, and they say the third row says 5-year experience study. So those are the documents I'm going to speak to. There's a different document for each system. General, police officers, and firefighters have their own. I was gonna start on page, since the investment return, is one of, for the general and the police boards, is one of the more influential decisions, that you make with regard to its impact on liabilities, if you change it. And the, the portfolio, although the firefighters are assuming something different than you are, collectively, everybody should feel comfortable that, there's a decent probability that we'll achieve our objectives. You know, if we continue to invest, in the manner in which our investment policy statement is written, and we continue to receive contributions from a very reliable plan sponsor, then the all of the benefit promises will be met. So I wanted you to see, this is, I think, I actually created this chart myself on page, sorry, I'm on the page that nobody knows. C as in Charles 4. So if everybody goes to C as in Charles 4, it should be, there should be a chart in the middle with the headings asset class, target allocation, and benchmark index. So in terms of the investment return assumption, this is what I started with. I went to your investment policy statement and I said, well, what are investment objectives, and what categories and styles are we investing in? And all of these percentages add up to 100%. So you can't, you can invest on margin. It's a rare public sector retirement system that would ever even consider that, let alone do that. But there are a few systems that invest on margin, but all the rest of them add up to 100%. So with that, I guess I want to say further before we leave this page. It matters. Like I can look at capital market assumptions from various investment advisors and money managers, but if you're not invested in those areas of the market, then how relevant is that to our assumption? How are we going to achieve those returns? So you have to know the asset allocation, and then if you flip to the next page, C as in Charles 5, and bear in mind, in the prior presentation, the trailing 5-year return is 8%. We're assuming less than that for the three systems, but we collected information on capital market assumptions based on what your asset allocation is. So these are forward-looking assumptions, not trailing 5 years or historical. What are the expectations from the investment experts for portfolios that look like yours? And JP Morgan is generally what Mariner uses. JP Morgan submitted information to us, so we included JP Morgan, but we also, what if JP Morgan was an outlier? What if they were overly optimistic or overly pessimistic? So we looked at 12 for over short term, and we had 8. Not all of the investment consulting firms provide longer term investment horizons, because if you well, I'll defer to Brendan, but has anyone ever been right over a 20-year period? Looking forward, we don't think so. So they're a little less inclined to put a lot of weight and merit in marketing the 20 and 30 year. What's relevant? What happens in the next 10 years? We're making payments right now. if we truly do have a duration of about 15 years, for our liabilities, we don't care what happens in 20 years, a whole lot. We care a lot more about between now and then. But nonetheless, all of these give us a range of outcomes. The 1 year expected arithmetic return on average was 7.13, but it was quite a range. It was some of the capital market assumptions from different, and they're all listed in case you want to know who they are. And BlackRock, J.P. Morgan, Makita, Mercer, they're all listed in the first paragraph on this page. So some of them were over 8% expectations, some of them closer to 6%, but on average 7.13. The standard deviation is pretty consistent with what we've seen for quite a while. Diversified portfolios between 10 and 12%. So everything looks believable at this point. The short-term expected median return is 6.47. So that's the likelihood that the 50th percentile is just something that's in the middle of a bunch of numbers, but it's the closest we have to every other year. You get good news, bad news, good news, bad news, but they're not always equidistant. The good news isn't always good enough to offset the bad news, nor is the bad news always good enough to but we'll dispense with my weak verbal definition, and these are long-held investment means of calculating long-term rates of return. And if the median return is 6.47 and the 1 year expected return is 7.13, a reasonable range of outcomes would fall between those two. But if you go down to the longer term, the 1 year expected return is 7.51, and the expected median return is 6.82. So those are a little more optimistic, certainly since they're higher, and we do have decades ahead of us. I discussed a little bit of why the short term is so important, but we do have what I refer to as the ultimate long-term time horizon, because the systems will outlive everybody, sadly. A lot of us are going to live to 85 or 90, but nonetheless, the retirement systems are going to survive beyond that. So we care a lot about the long term too. So the range of reasonableness roams from about 6.5 to 7.5, and we're recommending that you adopt a 7.25. So something you don't want to be on the very edge of the cliff, if you can take a few steps back. So you're still going to be safe as long as you don't fall off. It depends. I mean, how much weight do you put on literally and figuratively on the warranty of the railing, and the reputation of the firm that made the pipes as well as the installers. So, but the experience study looks at a bunch of other things too. But I wanted to make sure we talked in a little more depth on why we want you to reduce the assumed rate of return away from 7.5 to 7.25, and then salaries on the whole were up, and so we're recommending increases for all three systems. For salaries, I recognize that the firefighters are involved with Jacksonville, different employer, but the comparables and the local influences are still considerable. It's not like they're the decisions on pay raises are being determined out of Atlanta. They're local, and the local environment sees wages going up. With regard to withdrawal, the general employees actually were pretty close to expectations, so we're not, as far as turnover, we're not recommending changes. Police and fire were both lower than expected, so we're recommending a lower withdrawal assumption, so more people will make it to retirement. Conversely, retirement, all three, general police, not fire, but general police, their retirement experience was less than the current assumptions. So we're recommending a modest lowering of the retirement assumptions. So it's interesting that fewer people are withdrawing, and they're not the same people quite yet. We only looked at the last 5 years, but the people who did stay for a full career worked a little bit longer. They didn't retire at their first opportunity, and the withdrawal, disability, we really don't have any experience, and so we're not recommending any changes. But there was a time in the 90s, I don't know if it ever affected Jacksonville specifically, but disability benefits became really popular, and hypertension and things. There were doctors who were willing to certify that people qualified for disability benefits. There were tax advantages to doing so. So even people who were eligible to retire under normal retirement were retiring under disability benefits in some places. And that would exhibit itself by experience. We would see a spike in disabilities, which we did not see. So we don't have any reason to suspect that anything's going to change. So we have very little experience. I just was giving an example. Yeah, we're always going to have small experience, but if you start suddenly approving disabilities and it becomes a popularity issue where people talk to their friends and they say, hey, you go to this doctor and avoid heavy labor for a few years. So finally, we're not going to talk anymore about the mortality tables because those are mandated by the Florida Retirement System. We've already adopted those, and your legal counsel is here. It's illegal to change away from the Florida Retirement System mortality tables. So we're not recommending a change there. And let's look at the results pages.
You're required to use one of the two most recent that's adopted by the Florida Retirement System.
Within 2 years.
Correct.
So next year, well,
That's why I was asking, because most you guys adopted early. Most plans are doing this for their next valuation report.
So let's go back to, for everybody's, go back to B as in boy 1. Who was the boy 1 there?
Isn't that better? Robert.
It was Robin.
Robin.
Is it? And sorry. So for the general system, the demographic assumptions, if you adopt just the demographic assumptions, which we are not recommending, I mean, we want you to adopt the demographic assumptions, but we also want you to adopt the economic assumption change from 7.5 to 7.25. The demographic changes by themselves didn't have much of an impact, but the right hand column, the contribution rate went up 61 basis points, and I believe it's about $168,000 increase in the annual contribution associated with that change. But based on the limited education that hopefully I gave you earlier on present values, if we reduce the investment return assumption, we have to make up the difference with additional contributions. So then the police officers' retirement system, the demographic assumptions actually reduced their rate, but it increases with the proposed 7.25%, and that was a actually it's overall it's a decrease of 85 basis points and $35,000 decrease in the contributions. None of these will apply. We'll be back with next year's reports with results based on new demographic and financial information as of October 1st, 2025. So your decision today isn't going to affect anything until we do our next valuation report. And then the firefighters had a city contribution increase, but so about a little over 2% increase in the overall rate, and $60,000 increase in the contribution. But that was all demographic assumptions. We're not recommending a change to the 6.5. 6.5 fell in the range of reasonableness. So if you're going to talk about a range of reasonableness, you have to be willing to talk about an assumption being too low given the circumstances, and the 6.5 is still in what we believe to be a reasonable range. So but the demographic changes in this case, because the withdrawal rate, there's so few people remaining, and the withdrawal rates went down. So and I have 18 stuck in my mind, but the firefighters have something like 18 active members, and
It's
22.
20 something.
22. So 18 must have been when I registered for the draft. So 22 is it's very likely all those people are going to receive benefits. And the withdrawal assumption, when you have a closed group, it's kind of a lot of our variables are now known, and if they don't, if they all stay till retirement, then we're going to owe them, basically to the full extent that we promised, for a career in their position, if you give me credit for starting early, then I finished in 15 minutes. But again, I cannot use these assumptions without the board adopting them. So again, they need a motion. So.
I just want to mention that in the actuarial report, like the primary comment that you have for all three boards is that the loss was primarily attributed to larger than expected pay increases, and so that's what we're trying to address here. Instead of it hitting the actuarial report on the back end, we're trying to adjust the assumed.
So that we don't see that comment perpetuate,
right?
Going forward.
Thank you, Brad. Any discussion? Let's vote. Firefighters Board. Motion and second.
So the,
George Kindler. Yes. John McDaniel.
Yes.
Lance Hewish.
Yes.
Debbie White.
Yes.
so just to be clear for the record, the motion was to approve or adopt the assumptions changes as recommended by and presented by your actuary. Is that right?
Yes.
Okay, perfect.
General Board?
So moved.
Second.
Nick Curry.
Yes.
Dan Jansen.
Yes.
Christine Hoffman.
Yes.
Brandon Marisma.
Yes.
Jennifer Rotolo.
Yes.
Police Officers Board, please.
Motion. Second.
David Cohill.
Yes.
John Patridge.
Yes.
Matthew Grocki.
Yes.
John Godstella.
Yes.
Jason Sharp.
Yes.
Super. All right, Pedro, take it away.
Turned off my mic. I apologize. Just in terms of legislative update, I'll be brief. I know you, most of you, I'm sure, have seen all the headlines in the papers. Session was supposed to have ended May 2nd. It was extended through the end of June, through June 30. Primarily, really to deal with the budget and try and adopt a budget. However, obviously, any amendments can be brought to the floor, can be considered, can be voted upon. I just earlier I checked the schedule for the Senate and the House, and there does not seem to be anything with respect to voting on a bill on any of the calendars, at least for the next 2 weeks. It seems to all be budget related, but we'll keep you posted once session does end with a final legislative update. Not to bury the lead, that none of the changes that are being proposed or I think envisioned amendments in that respect will relate to pension funds. There had been 2 bills filed that would have amended local law plans such as ours, and there's a bill that was filed also that I think we've probably talked about in the last few years that would have amended Florida retirement system, essentially adding back a COLA for certain employees, members hired or retiring after July 1st of 2012. So neither of the 3 bills, I think, are the first 2 that I mentioned were effectively dead on arrival. I don't think they even got assigned to committee. And the FRS bill, it was really kind of stuck in the mud for the majority of session. And by the time, my understanding anyway, by the time they got the cost studies finalized and in the right hands, they frankly ran out of time. Obviously they could be brought back, but I think the expectation at this point is that if any amendments are made, that they're going to be really geared. I think you guys have probably seen there's some property insurance and some bills that have been proposed and discussed and debated and a couple of others, but none of them having to do with pension. So we'll keep you posted, but there should be no changes on the legislative front. Yes, sir.
So just for the benefit of all the board, I think by Florida law, the budget has to be presented by July 1st, so they can't extend it beyond June 30th, if I'm not mistaken.
They cannot extend it beyond June 30, although the governor can still call special session. But yes, it should be it. Okay. And then just the only other item I just want to touch on, again, not actionable, but just as a friendly reminder, your financial disclosure are due by July 1st. Your Form 1, I know for our elected officials, it's not the Form 6. It is the Form 1 that the restraining order or the Form 6 is still in effect. So it is still Form 1. Recall you are filing it through the ethics portal, through the website, like you did last year. So hopefully it's a little bit easier the second go around. My understanding is, and I haven't done it, but once you log in and you get onto the form, it will actually pre-populate from what you did last year, which I think is pretty helpful. So, presuming your finances haven't changed too dramatically, it should be pretty quick and easy. But if you have any issues or any trouble, just let me know, please. Okay, and then I guess I don't know if Ed Dawson is finally going to be leaving the board or not. I don't know, but if he does leave, he is going to need to file the Form 1F, the one final. So if you can just maybe put it on his radar if he is going to.
I don't know if you know this, but so I did a Form 6 last year because I did it before the
Before the court.
injunction went into place. Correct. So if you log back in, is it easy just to switch back to Form 1, or do you even know?
I don't think Form 6 is even available
Good.
any longer. But to your point, that whole, I don't think it'll pre-populate. I think it'll maybe have to start. I just don't know.
Okay.
You may have to start from new, but Form 6 shouldn't even be on there. It should really just be that Form 1.
Okay.
Yeah. I'm sorry you had to go through that last year. I heard it was a pretty heavy lift.
And this may be totally outside of the scope. I'm just curious. I think the governor signed a bill that offered more protection to like linemen and electrical workers. Like the penalties are higher for if you assault, and they're more along the lines of police and fire. Does that sound familiar to you at all?
It doesn't, but
Okay.
But it
And I
could.
just read the headline in the first paragraph, so I'm just curious now if there's going to be a trend towards treating linemen and frontline workers for our utilities
Right.
more like public safety. So I don't know if that was just a one-off type of thing or if it was
No,
a
I'm not.
trend.
I'm not familiar with that one, with that bill. So it may very well have passed, but I do know in the past couple of years, ever since COVID, really, I guess the term first responder, it's not, obviously it was typically for police and fire, and I think it still is, but they called them after COVID essential workers. So I think there's been a push, line workers, for example, obviously after storms and things like that. So I think there is a push to kind of help not only line workers. I know landscape, the guys removing the trees and cutting the trees down and things like that. But I can check. I'll check for you, and I'll shoot an email.
Pedro, you want to help me out with this next couple of them? Are we?
Sure. So the next item on your agenda is, and I think as part of your materials, you have presentations from portfolio monitoring firms, and so these are generally securities litigation attorney firms that will prosecute on a class action basis violations of securities laws and or derivative actions. And derivative actions are essentially breaches of fiduciary responsibility, right? And so as shareholders, you can bring these claims. It happens often if two companies are merging, and there may be some sweetheart deal for the company being acquired or whatever the case may be. And so if the value of the purchase is not as high as it should be, sometimes these derivative actions are filed. More often than not, you'll see kind of on just general securities violations where there's misstatements in their reports. In their earnings calls, they'll say things that aren't necessarily true, and so the market relies on these statements or on these disclosures, and the price of the stock suffers, right? So many of these firms will also offer portfolio monitoring services, and these are free services. They will essentially get access to each of the plan's portfolio through the custodial bank of the holdings. It's really just on the equity side. They will monitor for any kind of potential action that I described, and then they'll come back and if that action has been settled or there's been an award, there is a claim form that we would have to file. The pension fund would have to file as the owner, as the shareholder. When you file that claim form, then the settlement, you'll get a piece of the settlement, right? It's pro rata. It's based on how much you held and how much was settled for, or how much was awarded by the court. You've probably seen this in your own personal life. You'll get an email, or used to you get something in the mail. If you owned, a Frigidaire, or if you had a Volkswagen, and there was a class action settlement, and then you were a member, you'll have to file your claim form, and then a few months later, you'll get a check for, $2.34 or whatever the case may be, right? So on a bit of a larger scale, although monetarily not that different, pension plan is the same structure, right? So generally speaking, your custodial bank is responsible for filing these claim forms on your behalf. All of the settlements or by the administrators, all of the awards will go out to the custodial bank. The custodial bank goes ahead and files it on your behalf, and then we'll get that check back. That's not the bank's primary job, primary responsibility. So there are times when these claim forms are not filed, and so the theory is we're kind of leaving money on the table. Admittedly, it's not a lot of money, but so what these portfolio monitoring firms, the service is really, it's a free service to the board. It's just viewed as an extra check and balance really on the system. So they will provide a report, and so there are some firms that will file the form on your behalf for a fee. None of these three do that. They will provide the service free of charge, and they will provide a report, which I think ultimately my recommendation would be we forward that report to the custodial bank just to make sure, hey, listen, we know you got the claim forms, but just cross-reference and verify that these are the ones that we should be filing, and make sure that you file them. So, from my perspective, and many of my plans do engage these firms for these services. Again, it's a free service, and it's an extra check on the system just to make sure that we're trying to recoup or get every penny that we can back to the plan. So I think there might have been some discussion at an FPPTA meeting or at a conference or anything like that. But I reached out to three firms that I've a lot of my plans have used in the past. They have a strong presence here in Florida. They fish in different ponds, so to speak. So they're not always looking at the exact same cases. They're not always looking at the same actions. You have the larger firm, you have a bit of a mid-tier firm, and you have a smaller firm. There are a number of firms, so you're not required to use any of these three firms. I don't get any money or any fees or any additional compensation, whether you use the firms or you don't use the firms. So there's no I don't have a horse in this race. I just these firms have done a good job for my clients. They have a strong presence here in Florida, and so that was really why I thought of these three. But if there's other firms that you want to look at, we'd certainly bring them in. Each of the firms had requested or had offered to be here and make presentations to you all. We thought maybe we had a long meeting already, and so we could maybe discuss things with ourselves. If you want to bring another firm back at a future meeting to interview them or to have any questions, you certainly can. So, long story short, I apologize, it's too late already, but that's the purpose of, and that's what these three, decks that you have as part of your materials. That's what they're offering.
Pedro.
Yes, sir.
Just to confirm, we obviously talking to several of these different plans that had these and all these FPTAs, and most of them had more than one anyways, correct? So it wouldn't even hurt us to have, even if we wanted to go all three of them or two of the three, it would be beneficial, correct?
Yeah, that's right. That's exactly right. So I think to your point, a lot of it's free, right? So
Right.
it doesn't cost us anything. And I think since each firm, they have their own philosophy, they have their own approach to the types of cases that they look at, the types of actions that they may want to proceed with. Some are more aggressive than others, which is another reason why I generally like these firms. Again, not for any financial reason, but just because some firms will want to file a lot of actions and want to file a lot of lawsuits and want to prosecute a lot of folks. And nine times out of 10 they don't go anywhere, so we just kind of waste a lot of time. So these firms are not that, they don't have that same kind of discipline or approach. So I think a lot of my boards are receptive to that. But to your point, yes, there's no harm in having multiple. The majority of my plans have multiple, 2, 3, 4. I think there's probably a breaking point. You don't want to have 7, 8, 9. But I think 2 or 3 is very reasonable. Again, all you're going to be receiving is a quarterly report. And for the most part, you're never going to really hear from them, talk to them. If they do, and this is, I think, another point that I should bring out. If they do recommend that the board, serve as a lead plaintiff or as a named plaintiff in filing an action, that's an entirely separate discussion. That's an entirely separate engagement. That's also a contingency, and that's also a free. But that's not what we're considering here, or what you're considering here. This is really just for portfolio monitoring services. Yes, sir.
Yeah, I have a question. So obviously you have vetted them. Dustin, have you looked into these 3 firms? And I would imagine if you would have looked into it, that they've never had any litigation against the city of Jacksonville Beach of any shape or form.
Each of these 3 firms told me that there's no conflicts with the city of Jacksonville Beach.
Okay.
Or the
I don't know if you've looked into it or maybe run them by our city attorney just for.
I did not check with the city attorney, but I did ask each of the firms before, asking them to submit not a bid, but a proposal, I guess, or to run a conflict check on their end, and they all confirmed that there were no.
Right. I would prefer that was done with our city attorney as well.
Yeah, and that's a good, excellent point. I'm happy to, yes, we should do that. Absolutely.
So you led this session that Dustin attended.
I participated. Yes,
Okay.
It was a legal panel, but yes, I was.
I'm just curious about the timing because you said most of your clients, most of your boards have this coverage.
They do. They
So
do.
How come it's never come up to us before? I'm just curious about. And what other than Dustin happening to be
Sure.
in that session at the time, and it sounds like you guys were there too. Is it just?
No,
Yeah,
I mean
really
it's
encourage
not.
you
It's not something that I guess from my perspective, it's not something that I generally recommend to my clients to go ahead and kind of have this service. But if the board wants to do it, I support it.
Okay. So there's no downside.
There's no
No
downside, I
cost.
think, from my perspective.
Dustin is hovering
Again,
next to his button.
Dustin gets extra reports, but
I
We
kind of
don't have any more room at the table for any more consultants.
I kind of wince when anyone says something's free. So I'm just like, I don't understand, but I did inquire about how that's possible, and it's that they file these lawsuits, they get a portion of that, and I was thinking we got to set some kind of rate with what they're going to get, but as I understand it, most of the time when they settle, it's the judge is setting how much the attorneys get in the end. So it's something that's out of our control anyway. So yeah, it kind of is free, and that we engage them, and then they get us money, but the judge ends up determining what fee we actually pay.
So that's right. So, but again, there's 2 separate, and that's exactly right. But there's 2 kind of separate services that these firms offer. What they're proposing here is strictly portfolio monitoring. There's no fee to the boards. They will get a letter direction signed by each chair respectively, authorizing them access to the portfolio, and they have their system, and they'll put it in, and they'll provide a report to us with settlements that correspond if we have any of those holdings during the class periods. That's one service. Why do they do this for free, to Dustin's point? They do this, they provide this free service ultimately to have access to portfolios such as yours, because if they do find a case that they want to prosecute, then they have a potential pool of plaintiffs, right, of lead plaintiffs. that they can then come to you and say, hey, you held, I don't know, but what's a Tesla? Not to single out Tesla, but that may be a bad choice. But you own Tesla, and there's a great action that we've been researching, and we want to file against Tesla, and we want you all to serve as the lead plaintiff. Right? That would be a separate discussion. Obviously, that would be a separate engagement. To Dustin's point, if we go down that path and the board says, okay, we want to do that, we want to serve as a lead plaintiff or as a named plaintiff, there would be no fee. They prosecute, or they'll try the case on a contingency basis. If there is an award or if there is a settlement, attorneys' fees and costs are paid separate from the settlement, and so they will, have 20% or 15%, whatever the case may be. To Dustin's point, the judge has to award it. So they can request 30%, but the judge is going to say, no, that's crazy. I'm going to give you guys 10%. And so they'll get 10% of that attorney's fees pot. Again, so there's no money that we pay out. There's no money from the actual settlement that goes back to the shareholders. It's kind of a separate pot of money. But again, that would be a secondary discussion, a secondary conversation, engagement really of that firm.
Thank you for putting the words lead plaintiff and Tesla on the record here in Jacksonville Beach. Thanks in advance. But what if two or three of them are all going after the same class action? Is there any obligation to go with one or the other?
Excellent question. So there's never an obligation. You can, if they come and say, hey, we want you to file this lawsuit, and I have many plans that do this, they don't participate. They say, no, we'll, let somebody else do it. We don't, we're okay not doing it. So there's certainly no obligation that you kind of go to that next or that other engagement, or there is no there wouldn't be any requirement that I'm sorry, if there are multiple firms that are pitching the same case, I would think that it happens more often than it does. And I think I can only remember once or twice in the past maybe 20-some years that it has happened. And at that point, it's really the board. Each firm will kind of come and make a presentation to the board and why we're the best to prosecute this case. And the other firm will say why they're the best to prosecute, and the board would decide.
If the class action suit is lost and you're listed as the plaintiff, is there any consequence?
No. Typically what happens is the case will be dismissed. If there's any sanctions or fees that are imposed by the judge, that would be on the law firm, and that's part of the engagement letter. That's a good question. Part of the engagement letter, if you go to kind of that other step, right, in prosecuting a case or serving as a lead or a name, part of the engagement letter is the firm indemnifies the board against any costs, sanctions, fees that may be imposed by the court. So that's a good question.
Thank you.
Yeah.
Pedro, as far as a lead plaintiff, I know a lot of firms don't want to be a lead plaintiff, obviously, but didn't they also say in that panel, basically they tend to ask the firm with the biggest amount of pot that was taken, or the amount of people that was involved in this? That's what they typically try to go after lead plaintiff. So we would probably be on the bottom of that, right? Yeah,
typically. So it's kind of changed a little bit over the past maybe 10 years or so, but historically it was first to the courthouse, right? It was kind of a race. Whoever filed first, they would generally be appointed lead plaintiff and lead counsel. Then it kind of switched to who has the largest loss. To your point, right? Who so a lot of these statewide pension funds are typically serve as the lead, right? But now it's I think practically speaking, it usually ends up being who has the largest loss, but it's not required. It's not as automatic maybe as it was before. But to your point, if there are multiple lead plaintiffs and lead litigation firms, right, filing, the court will look at one of the things that they look at is, is losses, right? So first they'll look to institutional investors over individual investors. So that's kind of the first breaking point, all right? And then they'll look to, okay, who lost or who suffered the most in losses. And so while it doesn't have to be the filer with the largest losses, it generally is. Yeah. So to your point, there may not be that many opportunities anyway where firms would come to us and say, hey, you guys, we think you'd be a good candidate. Now, and this is I'm probably getting way too far into the weeds. The other types of actions that I described, those derivative actions, those really doesn't matter how much money you lost. And so those actions, there are, oftentimes smaller funds such as ours or other institutional endowment funds, health and welfare funds, that will serve as the lead in those kinds of actions, because the amount of loss doesn't really come into play. It's just, if you're a shareholder, you can file it, and so at that point, it goes more towards who filed first, and potentially, the reputation of the firm, and who has a better shot. So not to confuse the issue probably more than I already did, but it's an excellent point. It's a good point. So I think ultimately, there's no urgency to having this as part of your board, as part of your consultants. I think it does serve a purpose. I think, again, you can't be free, so it does help. How much it's going to help, how much money you're going to recoup as a result of this, I don't think you're going to break the bank, to be honest. But again, it's an inexpensive way to kind of add an additional layer of security to the plan, and potentially recoup some, found money, so to speak.
So should we just kind of stay this until I get it cleared to the city attorney? Then, because
I think that would be a good idea. Or if you want to, if you want to maybe, if you wanted to have these firms come down at some point and interview, or I mean, they could obviously present virtually as well. And while we're checking with the city attorney's office, however you guys want to do it, is fine. Yeah.
Would the board like to add that trust but verify? They tell you that there's no conflict, but we got to make sure that there isn't any.
Okay.
And I don't know that we can move forward with the motion without that being approved first.
Okay. I'm in agreement. I definitely don't want to do anything that's going to cause more problems than it solves. Would the board like for me to have one or more of these come and present at the next meeting?
I personally don't think so. I think this is more of a recommendation thing. It's not like it's a free service. We're not putting money into it. I don't think it's to the point where we need to do that.
Okay.
Kind of deal with it. It's a good recommendation wise.
And to your point, they wouldn't be sitting at your quarterly meetings. Unless you ask them to.
Yeah, no more room. I would be interested in hearing your recommendation though, prior to us voting on this, because it is only going to add to your work.
Digging into more. Okay.
Okay. So I think if what I'm hearing is you're going to check with this. I don't have to. We're going to check with the city attorney's office. If there are no conflicts, then I guess we'll put this back on the next agenda, and the board can make a decision at that point. And if there's anything between now and then, if there's another firm that you've seen or that you like or that you've heard of, and you want us to reach out to them, just let me know or let us know, and happy to get those as well.
Okay. All right. Next on the agenda to approve Sugarman Sussman Brandswell Herrera amended retainer agreement. That's way back in our books.
So I think this is me as well. This is our fee is a retainer fee. You guys pay us on a monthly basis. It's a flat fee. I think it's been the same.
2018.
Yeah, 2018. So we're not asking for an increase or a change necessarily to the retainer agreement. We're asking for, and we're asking all of our clients really, the amounts of disabilities that have been coming through with our plans, for better or worse, has increased dramatically. I would say. I don't know if it's directly, but if you guys recall, there was a nightclub shooting over in Orlando, the Pulse nightclub shooting, several years ago, and I mean, I don't know if it's a bright line, but it's a noticeable increase since then to now. There has been a noticeable increase in disability applications, police and firefighters specifically, not so much in general, and many of them are mental health related, but regardless, there's been there's just a lot more work in terms of these disability applications, and so we're asking all of our boards if they're amenable to it, to removing or excluding those disability proceedings, hearings from the monthly retainer, and those would be billed at the lower hourly rate that's included as part of your retainer for outside work, which generally I don't think we've ever charged anything outside of the retainer. But nonetheless, you do have that as part of your monthly retainer, the lower rate. So we're asking to exclude the disabilities from your monthly retainer, and those would just be billed at the hourly rate that's stated as part of the agreement.
Question for Dustin on that. Have you reviewed the financial impact to the city on this?
The financial impact to the city to the city?
So, yeah, billing it out separately.
Would be to the plans. We have not had many disability hearings in the last 9 years anyway. Since I've been here, we've had one in police prior to this year, and then in this last year, we've had 2 disability hearings. So, I mean, 3 in 9 years, and the number of hours spent on each disability hearing is kind of unpredictable. I mean, we've had this one experience where we had 3 meetings. I think that's kind of outside the norm.
Atypical.
Normally, these get solved in 1-2 meetings, and I just don't think it's a large financial impact to any of the plans. In the budget coming up, you'll see that I added an additional $2,000 to the budget for legal for each of the plans, just as kind of contingency, and that's kind of where I thought we might land on that. It's like $350 an hour for time spent on these. So that's, I think, relative to the size of our plans and everything, this is not that much of an impact.
Okay, thank you.
Dustin, I do see way in the back, I do see a few of the proposals from this paper as well. I do see the $850 per month retainer and the $350 an hour comes up. One of the current rates?
That are the current rates. So our current retainer rate is $850 and has been that since 2018. And so that is not changing. Yes, this is just renewing the retainer rate at the same rate.
That's right.
And the hourly rate as well.
That's correct. We're not changing the retainer rate. We're just kind of carving out. In that retainer agreement, you'll see that there are some things that have always been excluded. Kind of, if there's some sort of IRS investigation or some sort of administrative hearing from the Division of Retirement, or kind of these one-off situations. So we were asking to include disabilities as part of those excluded items.
They can be time consuming too, with disability hearing.
Yes, ma'am.
Would this exclusion cover disability applications that were made prior to May 12th, the date on the letter?
Yes.
So anybody that still has one in process now, it would just be moving
still
forward?
covered under the retainer. This would only be going, and I mean, this would only be going forward for any application at some point after the fact. And I think and if any comes in, you know, in the next immediate, I think I'm okay. I'm okay. Well, in the next, you know, in the next little bit, I'm okay excluding those as well. Again, this isn't. It's just the reality of from our perspective. It's a lot more work internally, and so that's really the reason.
Through the chair, like it still includes Brad Pitt and Angelina Jolie divorce cases.
Sure.
So,
Any additional discussion? All right, then we need a motion and second from each board if we're going to approve. This is to approve the amended retainer agreement for legal services going forward. All about the firefighters.
Motion to approve the amended agreement.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
General board?
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Rutello.
Yes.
And
Motion. Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocke,
Yes.
John Costello,
Yes.
Jason Sharp.
Yes.
okay, Brendan, your turn.
Good afternoon. Since Brad was speaking for more than an hour, do I also get to speak for more than an hour?
No.
So you have the one main book in front of you. There is a thinner book kind of tucked into the back. But I will start with the main quarterly book, which is the March 31 report. If you're going to follow along on paper, I'll start on page number 4. Just again, to kind of give you a quick high-level overview, I do have to qualify a lot of these statements that this is already very dated information. To say to put it lightly, the last 6 months have been a roller coaster, and not just a one-way roller coaster. But what you see there in the upper right-hand corner is the 3 months ended March 31. The kind of the blue-gray bars up at the top represent our domestic equities, and they're all to the left of the line, meaning they've gone down in value. The yellow or orange bars there in the middle, international stocks, are to the right, nicely positive, as are the red or pink bars, which are fixed income, nicely positive. If we had the 1231 report and you open it up this page and put right next, it would be essentially the mirror image of what we saw the prior quarter. So domestic equities were the only thing making money last quarter when international and fixed income were negative. Now this quarter, it is completely flipped. Sticking with that same sort of theme, on the next page, page 5, this kind of dives in a little bit more into the U.S. equity portfolio. And what I'm just contrasting is the difference between the blue bars and the red bars. So the blue bars represent value stocks. And you can see, I'll use the Russell 3000 up there at the top of the page as the example. The Russell 3000 was up 1.6 for the quarter. Growth was negative 10%. Huge difference in just a 3-month period. Now, if we were looking at December 31, value was negative 2% and growth was positive 7%. So again, the same sort of mirror image kind of flip-flop from what we're seeing quarter to quarter. And again, I just kind of goes back to that volatility comment that I made just a few minutes ago. It has been incredibly, not only is the market volatile in terms of being up one day, down the next day, but within those periods, it's growth working and value not, or vice versa, or fixed income doing really well and equity. There's a lot of pieces within the market that there's a lot of volatility between those different areas. I'm going to skip over the next handful of pages and go to page number 11. So I mentioned briefly fixed income, and I'll focus down in the bottom right-hand corner of page number 11. This is the Treasury yield curve. We typically spend a minute on this each quarter. The blue line represents where we were at March 31, as compared to 3 months ago, which is the kind of yellowy orange line. So as you're starting on the left side of the page, these are the shortest rates, the ones that essentially line up with the Fed funds. And what you'll notice for the first 3 dots as you move to the right, no change. The blue line is really right on top of the yellow line. The Fed didn't adjust interest rates, and those shorter kind of rates didn't move. But once you get out to the 1-year security and then all the way out through the 30-year security, you see that blue line quite a bit below the yellow line. What are we talking about? Obviously, yields are falling. Why were the yields falling on Treasury securities? Because there was a lot of buying interest. What was going on within the quarter? Really, the market was kind of freaking out, mainly because of all the tariff discussion and uncertainty. So if there's uncertainty in equity markets, so we're selling equity, where do we put it? The safe haven assets of U.S. Treasuries. So buying those assets, the prices go up, which means the yield falls. And just kind of graphically, that's what you're seeing here. Any questions on just the general kind of market environment?
Is that a trick question? Any questions on
Well, so now I'll jump ahead to page number 14. This graph, again, we show your information or plan asset data all the way back to 1987 when you had less than $12 million in the retirement system. In blue, we show the total market value, and you can see there way out in the upper right-hand corner, we finished the quarter a little over $126 million. And that compares to the red line, which is sort of the theoretical, if you were invested and just earned the assumed rate of return on an annualized basis, that $11.8 million would be $111.8 million. But because you've invested the way you actually have closer or north of $126 million. So outpacing that assumed rate of return over that extended period of time. The other part of this chart that we show along the bottom is the net cash flow. So those kind of blue or gray bars. And that's sort of shown on an individual annual basis or quarterly basis. For a number of years, that cash flow was positive. But roughly 2009, the plan went into sort of a negative cash flow, meaning you're paying more out in benefit payments than you're making in contributions. But you'll also see along that second half of the graph, that blue line is still steadily increasing. So even though you're paying out more in payments than you're bringing in, you're growing your assets at a faster rate, which ultimately leads to that higher value. And just in the table, you can see there, since inception, you've paid out over $51 million more in payments or benefits than you've brought in contributions. The next few pages dive into the asset allocation. Shown a few different ways. Page 17 is probably the easiest way to see that information. It's relative to the investment policy. You will notice as of 3/31, we were a little underweight equity. As you recall, when we were a little overweight equity, we had pulled some money out, put it into fixed income, also have kept some in cash. Now here in this after this 3-month period where equities sold off, because we had brought it back to target, then equities went down. That's why you see a little bit of an underweight. And then most of the other asset classes within about a 1% range. So generally speaking, looking pretty good. The other thing, as of today, that underweight in equity is much smaller because equities have since recovered some. So, all told, we're less than about 70 basis points off of our target as we currently sit.
And then you said as of today, does that mean today?
Sorry, as of last night or as of yesterday. Yeah. So I'm going to go ahead and jump with all of that said. How did the plan do? And as a reminder, this is the first 6 months or the halfway point of our fiscal year. So on page 21, you'll see in the upper left-hand corner, gross of fees, total plan was negative 17 basis points. But that compares to our policy of negative 78 basis points and would place in the 44th percentile among the peer group. as you move one column to the right, the fiscal year to date, so the halfway point, negative 74 basis points. So we are down. The policy, though, is down almost double that at 1.4%. So we are outperforming, but it's certainly in a negative environment. As you move down that page, you can see where that relative performance is coming from. Vanguard Index Fund did exactly what it's supposed to. JP Morgan, our value portfolio, did very nicely. They were up 2.8 versus that benchmark of 2.1, so slight outperformance there. And then Eaton Vance, or the Atlanta Capital, negative 4.6, but the benchmark was down 7.5%. So did nicely in the quarter, although you will see on the fiscal year-to-date column, negative 7.5 versus about negative 7. So a little bit of, again, what I was talking about earlier, last quarter to this quarter, kind of a mirror image. You see that a lot in the managers. If the manager did well last quarter, they probably struggled this quarter and vice versa. So Atlanta did very nicely, very poorly last quarter, underperformed, did much better this quarter, but when you combine the two, they are still just a little bit behind. As you flip to the next page, we've got our international portfolios. So DFA, this is the relatively new addition, was up 11.2% for the quarter versus the benchmark of 5.2, as compared to Euro Pacific, which was up 2.6, and WCM, which was up a little over 5%. And I just want to take you to that 1 year column. DFA up 11, and the other two managers up less than 1%. So I know it's been a relatively short time, a little bit over a year and a half or so, but that has certainly been a nice diversifying decision that you guys made to take some of that money from Europac as well as WCM and put it into DFA. And that has certainly paid off here in the last year or so. Fixed income down at the bottom or lower down in the page, we mentioned how interest rates had come down in the quarter. So the Baird short-term fund is not as subject to those rates. Again, I mentioned the left side of that yield curve didn't move much. And so they really just kind of clipped their coupon, earned the 1.6% right in line with the index. But Sawgrass, which is longer out in the duration and maturity spectrum, they earned over 3.3% versus that benchmark of 288. Also, as a reminder, Sawgrass was one of the recipients of some of that rebalancing. We had taken money out of equity when we were overweight, and a good portion of that went into Sawgrass. So in the last 3 months, our equity portfolio was down 3-4%, and you put it into a portfolio that went up over 3%. So just another example of that ongoing rebalancing certainly benefiting the plan. And then the last part of fixed income down there is our global with PIMCO diversified income. They were a little behind, 2% versus 2.6, but you'll notice whether the fiscal year or 1 year substantially ahead of the benchmark and also outpacing the domestic fixed income. And then on page 23, the very last piece of the portfolio is the JP Morgan Strategic Property Fund. Relatively nice return, 1.04%. It's been, I think last quarter was positive also, but it has been a couple of years since we've really seen some steady positive returns out of real estate. So certainly nice to see that here. Now, as a reminder, we are in the redemption phase or trying to pull that money out of JP Morgan. And I think coming up for your next meeting, we're planning to bring some kind of replacement ideas, get that conversation going. It's not going to happen right away. JP Morgan is kind of sending that money back slowly, but we want to make sure we're prepared and ready. So as we're getting that money in, we have a place to then start to send it to maintain that real estate exposure. Let me pause there, see if anybody has questions or comments, anything that I've skipped.
That real estate that's coming back to us, is it going to be reallocated to real estate? Or
that's going to be the discussion. So I'm looking at bringing in some managers for you to consider to reallocate or to maintain that exposure. But at that time, we can also have a discussion whether we want to tweak or adjust that allocation. Maybe we want it higher, maybe we want it lower, or to completely eliminate it. But as a part of that conversation, we want to make sure we're exploring some of those potential landing spots if we want to maintain some allocation.
Before we added a couple other options, private equity alternatives. Um, should we look at those managers as well?
We certainly can, but I would almost, that's kind of a separate discussion. So, you know, within the current investment policy and the allocation, we have this real estate that we're slowly backing out of. So unless we want to make a change to that piece, we want to explore, you know, kind of backfilling that allocation and having a landing spot for those dollars. But aside from that discussion, then is, you know, we made that change last year, sort of carving out that potential area or that bucket within the IPS that could allow for some of those other asset classes. And that's sort of that separate discussion to potentially consider that. David, do you have a question?
Yeah, I did. Just looking at Euro Pacific just as the fund itself, I just think we've kind of gotten to that 3 to 5 year time frame where they're underperforming the index. And is that specific fund one that you would look at possibly moving on from?
It is one that has seen, how do I say, selling interest.
Okay.
Historically has been a very good long-term fund, and even, you know, your longer-term numbers with them are still good, but the last 4 to 5 years have been, as a general rule, kind of consistently struggling. And it's certainly one that that some folks have struggled staying with. You know, one of the reasons, you know, part of that was it does have a little bit of a growth bias to it, which again was part of the discussion about why we wanted to take some money and put it, you know, somewhere else, ultimately landing with the FA. But even within that growth space, it's definitely something to consider. Again, from a firm, from a team perspective, from a strategy perspective, we haven't lost faith in what they're doing, but it has been an area that has struggled now for a few years. And certainly, those are not the results that we want to see. We do expect them to turn around, but it hasn't happened.
Okay. How long would you give them to turn around? Till we start as a board?
Yeah, I would, within the next 6 to 12 months.
Okay.
Is a, you know, again, because at that point, you've kind of had almost what you'd argue is that sort of normal cycle, that 3 to 5 year sort of time. If you haven't seen it turn at that point, then we might want to look at making an adjustment.
Okay. Also, the other thing I have is we have significant exposure just in that total stock market index.
Mm-hmm.
What's your feeling on that?
It is broad market, very inexpensive exposure. With what has happened with the Mag 7 kind of large cap names, it has become a more concentrated index than it historically has been. I think there's arguably a little bit more risk in it than there certainly has been over time. But I don't think it's undue, you know, relative to the overall plan. You know, as the end of March, you had roughly $16 million in that portfolio against a $126 million portfolio. So I don't think it is unreasonable in terms of those allocations. You know, if the plan was 60% in that fund, like if all of your equity exposure was there, then it may be a different discussion. But I think it's very reasonable. Also, again, given the very low cost nature of that type of portfolio, where you see an even greater degree of that concentration is within large cap growth. So a lot of folks have indexed, either have or are looking at indexing in large cap growth. Now, we don't, we're active with Winslow, but that particular benchmark, the top 10 names represent about 60% of the index. So you feel like you're getting this broadly diversified index of 400 stocks, but in reality, you're getting the vast majority in only 10 companies. So that's a more nuanced conversation for some of those, you know, plans with those type of exposures. Sure. I also included an April flash To be honest with you, I'm going to tend to really skip over this because this is already incredibly dated. Just the top line is through the month of April, we did lose. We went down a little bit where the benchmark was slightly positive. On a fiscal year to date basis, we were still outperforming at negative 82 basis points versus a negative 106. But what I wanted to update you is, again, I ran the assets as of last night, and we were at $129.4 million, which on a market value basis is 2.6% higher than where we were at the beginning. So if you add that, 2.58, you're sitting roughly about 1.7% to the positive on the fiscal year. So again, not quite at 7.5 or 7.25, but certainly better than the negative territory that is in both the quarterly report as well as the flash report. And again, with those numbers, we were closer to that target. I mentioned it was within about 70 basis points of the target weighting in terms of equity exposure because of that bounce back. Let me pause. Any other questions or comments?
Just real quick on page 21, total fund policy, you have in quarter one, that 44% performance. What is that? Can you just give me a...
So just pretend for a moment that there were only 100 public funds around the country.
Okay.
And at the end of the 3 months, you take all the returns of those 100 plans and you rank them from first to last. Your negative 17 basis points would put you in the 44th position. 43 would be better, and 55 would be lower. So obviously there are more than 100, but you take the population of all the plans, and then you kind of create a percentile between the group and that number. And so I'll show you another number. See where it says all public plans total fund median? That negative 43 basis points, so that's the 50th percentile. So if a plan earned a negative 43 for the quarter, you were right in the middle, 50th. Sure. And that is everything that I have for you today, unless you have any other questions. I'm sorry, that was way short of an hour. Just keep talking.
So when my grade school teacher said I was 99th percentile, that wasn't very good.
Just depends what they were talking about.
Brendan, there's not a suggestion on a rebalance or reallocation. I have that.
Yeah, it's kind of just a standard placeholder within the agenda because we're, for a good couple of years, every quarter we were bumping up against a maximum or something like that. But because of the rebalancing we've done over the last, 6 or 9 months and the market kind of going up and down, we're really right on target. So there's nothing that is required or needed at this point.
10-4.
I think with the pre-G, right?
Okay. Yeah. I don't know if we do that by board or do we approve by board or as a whole? I think by board. All right. Firefighters, can we have a motion in a second?
Motion to approve.
Second.
George Camley,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
Gentlemen.
Second, I just wanted to add that on there. It says AMCO and Consulting. That actually should say. I did. Second.
Yes. Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Beresma,
Yes.
Jennifer Rotolo.
Yes.
Police board.
Motion. Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocke,
Yes.
John Gostilla,
Yes.
Jason Sharp.
Yes. Sorry.
All right, Dustin, bring it home.
Hey, Brandon, one more question for you. So next meeting, we're gonna see some options for real estate. That's the plan?
Correct. I can also, again, bring additional information if the boards would like, but relative to the real estate, again, we have that designated exposure, but we are in the process of pulling back from it. So we just want to make sure we have something ready to go. So as that's coming down, we can kind of build it back up, unless the boards would like to make a different decision. But that would not be my recommendation.
Okay.
Now, the direct lending and all the stuff that we had talked about eons ago, that still falls under the equity component, right?
The alternative, yeah, and we kind of, the little kind of earmarked sort of bucket sort of split between kind of equity and fixed income.
Correct.
But it also, again, depends on if you're interested in pursuing more like a private credit, which is private, fixed income, if you will, then that's more on the fixed income side as opposed to but if it's private equity, then that's then the equity side. But again, all within the limitations of the ordinance.
Okay.
And we should expect probably some follow-up to Member Coville's point about your specific next board meeting.
Happy to.
Okay.
Okay. So I'll be presenting the 2026 proposed budgets for each plan. We'll start off by just kind of talking generally about the revenues and expenses and what assumptions we make and things, and then go into specifics of each plan. Sorry? Yes, sir. All right. Investment earnings for revenues are calculated at 7%, and that's just to be a little bit conservative versus our assumed rate of 7.5%. Rather underestimate than overestimate when it comes to those kinds of things. Member contributions obviously set at 7.95% for all three plans. This year, the city contributions are set have a 17.9% increase for the general plan, 43.3% for police, and 0 for fire, obviously, because that's a set 10-year rate that the city is paid off the unfunded liability. I think we're in year like 7 on that or something. The tax revenues, we just calculate based on last year actual. So whatever came in from the state, it's very difficult to project what those are going to be. So last year actual is the closest I can really get on that guess. Budget assumptions and expenses. Total expenses are fairly consistent with prior year. Most of the biggest portion of the change this year is going to be in pension benefits paid out to each plan and just trying to adjust for what I think might happen between backdrops and new retirees and balancing that with how many people have passed away and things like that. For professional services, we did have Mariner has 3% increase every year, and then, as I mentioned earlier, legal increase of $2,000 per plan, just as kind of a contingency for a possible disability application. All right, we'll get right into it. Oh, and I do have an increase, a projected cost increase for the death audit software.
So before you go on back to the original first screen, the 43.3% increase for police, that's because of the increased salaries and adding employees? Yes.
That's because of a lot of things. That's pretty much what Brad's whole presentation was. I mean, there's a whole lot that goes into that, but the primary drivers are wage increases that were higher than assumed. That's that and some other assumption changes, the mortality table adoption, and some other things. But yeah, there, over the last, there's a report in the actual report that where average salaries for police have went from mid 60,000s to low 90,000s in about an 8 or 9 year period. That's a significant increase, and the 10-year change has been for general and police at 4.8% per year, which is compounded quite a bit higher than the 2.5% that was assumed. So that's what's created kind of this change. For general employees here, investment earnings, this is budget to budget changes. So we're got an increase of about 5.9%. So how I do that is I take the most recent valuation that we had and project the 7.5 on top of that. So just it's hard to determine how much our investment earnings are going to be in the next year, but that's as good a guess as any. Contributions from the members in the city come straight out of the actuarial reports, so not much there to really go over and above what Brad has already discussed. On the expenses side, this is more what we can control. Personnel services, that's not just salaries, but that's, city contributions to pension funds, that's healthcare expenses, that's payroll taxes, that's everything that goes into having employees. The actuarial services, I try to make those consistent across all three plans. So you'll see the police and fire. When we get to those, I made those 22,500 as well. In the past, we had police and fire be higher than general plan because they generally would have some additional requests for numbers and projections to be ran. That really doesn't happen anymore since we've got the city pay for the pension software, and all the employees can run their own projections, and I can go over them with them and things, so there's not really that additional cost any longer. There's the legal expenses up 2,000, investment expenses up $500, just that's Mariner's projected increase, and the other expenses, this is the death audit software going up from 700 to 1,000. We'll get to that presentation in a minute. That there's kind of a wide range that we have in the options there, from 6,000 per year to 3,000 per year. So it's actually lower than that. There's one option that's lower than that, but we'll get into detail on that later. The pension benefits increased. I put some additional dollars in there for the general plan. Again, that's just kind of best guess on how many people have passed away, looking at 2024 actuals, and how many people have retired. How many people took backdrop then versus what I'm thinking, or what it's looking like from what people have talked to me for the next year. Again, I'm projecting out from October of this year forward 1 year, so it's just kind of difficult to know that far out exactly what's going to happen, but that seems to be in line. If you look at actual on 24 general expense, I think we actually were higher than that total number. Yeah, it was 5.9 million. But we did have quite a few backdrop payouts last year that was kind of unexpected. So, and some high dollar ones. So that kind of put that number out of line with what I kind of expected to be going forward. Moving on to the police officers, we have the taxes there coming in on revenues, and those are again based on last year actuals. Investment earnings up, members and city contributions, the actuarial reports, and total revenue increase about 15%. Personnel services, same increase projected at 8.8%. I get those projections from our finance department as well. So that's not really my projections. That's their budget extrapolation for the city. Actuarial, like I said, they're trying to get everyone in line there at $22,500. The legal expenses, investment expenses up $500, and then the increase for the death audit software. The pension benefits were pretty much in line for police, with actuals on that as well. It's pretty much the same scenario that I had talked about with the general plan, as far as there was like 3 retirements last year, and they all had backdrop payouts, which is kind of abnormal. So I don't know if that's going to be happening in the future or not, but when I looked at this year's trending actual when we were 6 months through the period, it didn't appear that we were going to go over that 1.9 mark. So I just kind of stuck with that. Those other expenses, I mean, those are mainly, you can see it in the detailed budget. Those are travel and training expenses, liability expenses, and accounting and information systems budget. It's just kind of a catch-all for all the extra things that's provided. Any questions there?
Is that the fiduciary? You say liability? Is that the fiduciary liability?
It is fiduciary liability risk insurance. On the firefighters, same kind of thing here with the revenues. Just won't bore you with that, but we do have the City of Jacksonville increase. You can see there again from the actual report. And on the expenses side, pretty much the same expenses that we've had in the other two, except down to the pension benefits. We did have a retirement, and I have had several firefighters reach out to me looking at retirement. So I'm kind of projecting out, half a year to a year and a half from now, we might have 2 or 3 retire. So kind of bump that up a little bit in the pension benefits. Any expenses or any questions on any of these? Okay.
Okay, let's vote to approve the 2026 proposed budgets. Got to do it by board. So firefighters?
No moved. Second.
George Candler,
Approved.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
General?
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Marisma,
Yes.
Jennifer Rutolo.
Yes.
Police Officers Board.
Motion.
Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocki,
Yes.
John Godstilla,
Yes.
Jason Sharp.
Yes.
All right, Dustin, back to you.
Yes, sir. Moving on to the death audit software proposals. As you'll know, we've been using the same software for several years now, and then we had a couple of employees that didn't show up on that. That was through Berwin, which is one of the people that were that submitted a proposal here. However, that was through a older software that they had that they are sunsetting, and we were planning on moving away from that, obviously, anyways, because of that it didn't show up a couple of those employees. But that was definitely their budget version and an older software that they had. It was only $600 a year for all three plans. And it just didn't check as many databases and didn't have the same features as all three of these have. So we did get these three proposals here. Berwin Group with their software CertiDeath at $3,000 annually. They provided the option of either doing a 1 year or a 3 year to lock in that $3,000 for each year for 3 years. And then Guidehouse at $6,000 per year as an annual commitment. And then Pulse 419, which provided a breakdown there. Yes. So basically, yes. But they're, when investigating these companies and getting these quotes, they're different size companies and they target different markets. So they definitely seem to have a small, medium, and large build to them. That Pulse 419, for instance, I was getting quotes from them, talking to them, looking them up. I mean, this salesperson or the person I'm talking to is the president of the company. You know, so I just started looking into them. It just seems like they're too small for my comfort level. For that they, I asked for promotional materials to provide to the board here, and they said they didn't have any available. They didn't even have any, though they've been in business for 20 years. It's just a small company. And then a couple of days ago, I did put some in the agenda here because they reached out and said, "Oh, these have just been approved," and provided a couple of pages of promotional material in there. That one's the only one I'm kind of uncomfortable with, just because of how small it is, and I don't see that the price difference is enough to. It just seems risky. The Berwin group with their new software, this group and the Guidehouse, they do seem to be doing the exact same thing, although I would say the Guidehouse one is a little more all-inclusive in that Berwin gives you a report of who they have that got flagged on a database that may have passed away, right? Well, Guidehouse will take that report, and before they give it to you, they have people independently kind of verify it. Go in, find the obituaries, and like send you the obituaries and things like that. We're like a medium size. I don't necessarily need that. I'm going to verify each one of these. If they flag somebody, I'm going to reach out. Somebody here knows those people, or I'm going to reach out to family members, and I'm going to verify it anyway. So I don't need to pay for that additional service. And also Guidehouse, if you look at their quote, it's like for like 3,000, up to 3,000 records. They're just used to doing much larger state-run programs and stuff than what we necessarily need. So I think they would be a fine option for us, but I'm just not sure that it's worth twice the price. For it seems like they're Berwyn and Guidehouse do the same things and would provide the same level of service for our needs. So in the end, I'm recommending that we go with the Berwyn group Start to Death, and if possible, if we could do the 3-year agreement, that would be great. It is kind of difficult to get these companies to quote this out every year. They get tired of giving me quotes and me not going with them each year.
Any more discussion? All right, do we want to have a motion to, hire the Berwyn Group to buy that software?
For the 3-year term, if possible.
Is 400 records of searching enough?
Yes, we have, well, per month, yeah, we have 264 retirees, so I'll run it once per month. And, yep.
3-year contract? Okay. We want to make a motion?
Second.
3-year contract for
The Berwyn Group.
Second stands.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
General Board?
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Ricciello.
Yes.
And police?
Motion.
Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocky,
Yes.
John Gottstilla,
Yes.
Jason Sharp.
Yes.
Okay, Dustin, you're going to talk about the disability verification forms.
Yes, this is not, I kind of brought this at Pedro's recommendation. In the past, I don't know that we've necessarily brought these kinds of forms in front of the board for approval, but he said we should, so here we are. But we, again, at the FEBTA meeting, at the last one, I was definitely at your presentation on this one, where we said we should be confirming that our disability recipients are continue to be disabled, and and in accordance with our ordinance and everything else. So we went to Pedro and had him draw up some forms here for us, and we kind of went back and forth on a couple of items because we wanted our some of our board members wanted to make it as easy as possible for the retirees to do this, and where we kind of settled on that was creating a form that the retirees could take to their doctor, physician, specifically MD or DO, to have them sign and attest that they are still disabled, continue to be disabled from the position that they previously held at the city, instead of just asking that physician to write a letter or something like that, because that can be, just trying to get a doctor to write a letter can be very difficult. So just having a form that they can just check a box and say yes and sign seemed to be the best solution. Anything to add there?
No, I was going to say that's exactly right. I think ultimately it's not a requirement, but in the same vein that you're performing these death audits, right? Ultimately, our number one job, I would say, is obviously we need to pay pensions out correctly, right? And so for a disability member, what that means is that they remain disabled. It's total and permanent. Similarly, for our members, with the "Are you alive?" letters, or making sure that they're still alive and we're paying the right person the pension and not, cousin and a nephew, whomever, right? That's right. So this is really just in that same vein to ensure that and luckily we don't have many disabilities, so it's not too much of an administrative burden, obviously, on Dustin and everybody, but it is something that I think is helpful and beneficial for the plans to have as part of their processes. How often you do this, I think, could vary. It could be, every year. It could be every 2 or 3 years. It could be every 5 years. It could be twice a year. I mean, I think if you're asking me, I think that may be a little bit of overkill, but I do have some clients that are very very diligent. Let's say.
What is the frequency of the death? Is that annually?
It is now. Yeah. I mean, it hasn't been. It previously was, and then once we got the death audit services, we had stopped doing the proof of life forms. But at the last meeting, we said annually, let's do the proof of life forms. So that's the plan, is to continue to do that annually.
It would seem like if we just coincide with the death one all at once.
Yeah. So I did not send the proof of life forms out to the disability recipients, because that's kind of going to take the place of the disability recipients.
Yeah. No, but I meant at the same time. So.
Yes.
Yeah.
I do have a question for Pedro while we're here. Particular situations like, say we just had a retiree get approved for disability who would have normally been retired later this year anyway.
Right.
Next year, what would the need in verifying the disability of that individual be? Because they would continue, whether or not they're disabled, they would be qualified to receive that same amount of money.
They're receiving the same amount of money. Technically speaking, it's because we're paying a disability pension. To your point, practically, fiscally speaking, it's the exact same thing.
Mm-hmm.
The lawyer in me wants to say that the distinction is that they remain disabled. Another question I think you could also ask, or I should have addressed, if there's a disability, if it's an obvious disability. And what I mean by that is someone has a terminal diagnosis, right? Or someone is missing a limb, or is a paraplegic, or, one of these kind of, we call them apparent disabilities. And there's case law that essentially says, for these kinds of folks, you can shorten the process considerably, because obviously this person is not going to get better, right? It's not something that's going to change. Mm-hmm. So I would say that, if we're going to be sending them a letter, an "Are you alive?" letter anyway, I would just say, even for those folks, just send them the disability verification letter, just because we're still paying them a disability pension, just to kind of keep everything on the same track. But I'm not opposed if it becomes cumbersome, or if it becomes kind of a too much of a pain, that we can shorten that step.
No,
it's a good question.
Yeah,
it's a good question.
Wondering. So. Okay.
Do these forms open up a potential lawsuit for the city? Because when somebody does a disability case, their records are open to the board. But once that's granted or denied, and then now you're asking this person about surgeries and to open up about what they have, is that a potential problem? Does that violate HIPAA? It forever open book to the city.
It would not violate HIPAA, and we're not asking for specific medical records, although obviously the form does include medical information. There's a continuing obligation, and it's part of your local ordinance, your local law, as well as state law, not necessarily for the general plan, but for the police and fire plan. It's in 175, 185 as well. That authorizes the board to periodically verify, right? And so I don't think it opens up any issues in terms of privacy violations or anything like that. I think as a public employee, just by nature of your employment, there are there are things that are public record, and so this would be included as that.
Thank you.
Well, when you get the forms, who's gonna make the determination whether they still meet the criteria?
So I think generally what will happen is the form will be delivered. Dustin will see it. 9 times out of 10, the doctor is going to confirm that yes, they remain disabled. If there is one that comes back questionable or comes back no, they're not disabled, they're fine, or something other than they remain disabled, then I think Dustin would bring that back to the board and we would have that discussion. Or he could forward it to me and we can maybe address it that way. But ultimately, it's going to come back to the board. I mean, neither he or I can make that decision, but that would be the process.
I was just wondering what the process
No,
would be.
we didn't talk about it, so it's a
Yeah.
good question. But that would be the process that I would envision or I would suggest.
Okay, thank you.
Any more discussion? All right, so the wording of this is to use the disability verification forms created by
Yes. Approve the forms as presented and authorize your administrator to periodically send them out. I think I heard with the proof of life verification letters.
Okay, let's start with the firefighters board.
So moved.
Second?
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
Debbie White.
Yes.
General board,
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Marisma,
yes.
Jennifer Rutello.
Yes.
Police board,
Motion. Second.
David Cohill,
Yes.
John Patridge,
Yes.
Matthew Grocki,
Yes.
John Godstella,
Yes.
Jason Sharp.
Yes.
And Nick, let me add to what I said earlier to your question, because it's a good question. It's a good point. I should have said it earlier. We will have these records. Your administrator will have these records. The board of trustees can see these records. If there is something in that form that is personal medical information, and it is somebody does ask for or put in a public records request or something like that, we can redact it. So as to not any kind of personal or sensitive information. So if they start listing surgeries or blood types, or I don't know what they would include, but if it's something like that, just similarly, I think it has birth date on there and things like that, that would all be redacted. So to answer your question, I think more completely, even if we have that form, if there is something in there that the doctor includes that we believe, obviously it would be me, I think, making the call, that's privileged or confidential, then we would redact that for public inspection. It's a good point.
okay, Dustin,
Onto the quarterly pension administrators report. This will be pretty quick. I think the next upcoming FPPTA meeting is in June. I think I have everyone signed up for that requested to. I do want to relay what Pedro said about the Form 1. I should have put that on this page as well, and I'll get with the city clerk's office on sending out emails with links and dates that it has to be done and all that, like we usually do. The proof of lives have been sent out. We're still got 34 outstanding. I think 33 now, once Debbie turned hers in today. And so we're tracking those down. I think what happens is a lot of people just see them, they think it's their pay stub, and they toss it in the garbage. And so we've sent out another round of those with urgent marked on the outside of it, just something to make them open it up. Next quarterly meeting, Tuesday, August 26th. 3 p.m. So kind of back on our regular schedule of Tuesdays, and 3 o'clock. Any other items for me or things you want me to look into for the next meeting? Okay.
Okay, we've got a few applications for retirement to approve. This is the general board. Application for retirement, James Healy, utility plant operator, effective May 1st, 2025. Separation date, April 11th, 2025, meets age service requirements for normal retirement. 18 years, 4 months of service. Have a motion?
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Rutello.
Yes.
Application for backdrop retirement, Sherry Gosselin, city clerk, effective February 1st, 2025. Separation date, May 31st, 2025, meets age service requirements for normal retirement. 30 years, 4 months of service.
So moved with great reluctance and sadness.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Rutello.
Yes.
Application for non-duty disability retirement, Robert A. Lip, electrical engineer, Beaches Energy, effective June 1st, 2025. Separation date, April 23rd, 2025. Approved for non-duty disability and special hearing on May 7th, 2025. 19 years, 2 months of service.
So moved.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Brandon Maresma,
Yes.
Jennifer Rutello.
Yes.
Any other discussion? Okay, we can adjourn. Oh,
I need to address the police board very, very briefly. The city has approached GRS with an engagement to value some benefit changes, and we expect to enter into an agreement, and they're paying for it, so it's confidential as to the specifics of the request and the results. But I wanted to make the board aware that we have been approached. So speak now or forever hold your peace, I guess. We believe we're best positioned from the perspective of our knowledge of the retirement system, but we will use information that we received from this board, the member data and assumptions and things like that to perform the work. So, sorry about that interruption, but it's important. Thanks.
Dustin, one thing for Mr. Aliff.
Yeah, it should be 2024 separation date.
Okay. So, reading your lips. Okay, any other discussion? Okay, we're adjourned.
Christine, that bill, it did